It's just past 12 noon in the East. There you go. Dow's good for about 250, 0.75%. S&P 1.5%. There's the Nasdaq though, near 300 points. That's 2.5%, 381. The yield on the 10-year. Bonds up, yields down. So Josh, rates are down, the dollar's down. And the story of the day, obviously, is the inflation read, but the fact that Nasdaq's up 2.5%, and many of the biggest names within it are absolutely crushing it today.
Yeah, one of the main things going on is that markets, the stock market in particular, is anticipatory. It's not thinking about the quarter that we're in, although it is reacting to some better than expected earnings reports from consumer-driven names and retailers. But generally speaking, the market is now trying to look forward to 2023. And it's a relief. We can stop panicking about accelerating inflation, and we can get on with panicking about the new recession. And that's, look, that's the rhythm of this business. That's just what it is. Yep. What's the next thing to worry about? But the market doesn't seem particularly panicked. One of the curiosities of this era, the amount of tightening that we've had historically, you would have seen stress in the credit markets. We're not seeing that at all. Why? Companies spent 2 years re-liquefying their balance sheets, raising money with their eyes closed. They've got plenty of cash, and there's not a lot of stress. And then the other place that you would normally see tightening start to affect retail sales, nothing of the sort. Look at Walmart, look at Home Depot. You've got price increases that have been put through. The consumer really hasn't blinked for the most part. There are some individual stories that are talking about a softening, but by and large, the big companies, the Fortune 500 names, they have weathered this tightening so far. And it doesn't really look as though they want to give drastically lower guidance going forward. So that's where we are today.
Steph, Josh uses a great word, anticipatory, because Professor Siegel this morning speaks to that. Yep. Quote, I think this moves up the pivot. All we need is for them, the Fed, to recognize what prices on the ground are actually doing, and they are not going up. So is it time to anticipate the Fed slowing the pace of hikes, as some in the last couple of days have suggested? That clearly the market is trying to get on that side of the page and think that we have some room to run here in stocks.
We're getting to the latter stages of the Fed, but I don't think they're going to change from December of 50 basis points. And then we're going to have to see in January and February what the data says and what the data is telling us, and whether they do 25 in February, another 25 in March. Who knows? That's a lifetime away from where we are right now, right? And in the meantime, it does look like the CPI and the PPI inflation has peaked. It's not only those two factors, though, right? It's wages. And then at the same time, we got the New York Fed manufacturing prices that actually went up in the month of November. So we have a lot of conflicting data. But if we've peaked, that's a good thing. I just think we're going to stay very high. I mean, the numbers are still quite high.
Staying high is better than going higher.
Of course, right? But that means the Fed stays high.
Well, we know
higher
that.
For longer.
Higher for longer.
And even the Fed funds futures, it's not at 5% any longer. It's in the 4s. That's a good sign, but it's still high, Scott, right? And so I get the rally today. Rates down, long duration assets up.
Well, it's not just today. I mean, the move.
It started last week.
Last week.
Yeah.
Does it open the door to 4,100 on the S&P now?
Well, I have been saying that I think we can rally into the end of the year because of seasonals, but also because of positioning. And if you keep on having rates fall or not go up, and long duration assets work, well, you always ask us, if tech doesn't work, can the market work? Well, if tech works, that's a nice tailwind for the overall market because that's 35% of the weighting in the S&P 500.
Tech's working today,
sure
Sarat, as we said. But the next stop, right? 4,000 has proved to be fairly significant resistance. So assuming we can get comfortably over that level, do we need to start thinking about, these next incremental steps like 4,100 on the S&P between now and the end of the year? Is that realistic?
I mean, it could be realistic because I think Steph outlined it well. We are in a time period where people are positioned for year end. So you've got a few cross currents going over there, too. I do think this data is going to be really important. I mean, one of the things that we have to see is demand being destroyed, and you haven't seen that. And I think if you don't see that, then the Fed's going to be pretty strict to what they're saying. And I think you're going to be range bound. You're not going to really go through 4,100 because the market's saying we don't know and we're going to stop.